In June of 2026, right in the middle of, honestly, one of the most volatile macroeconomic crises in modern history, the largest institutional gold fund on the planet just aggressively dumped 17 metric tons of gold in just 4 days.
Yeah, which is just staggering when you think about it.
Right. I mean, it completely defies the fundamental gravity of economics.
Yeah.
Usually, when risk goes up, money flows to safety, supply goes down, price goes up. But this event, it just threw all of that right out the window.
It really did.
So today we are bringing you into a deep dive on this stack of intense, highly analytical, almost forensic financial texts. We're looking at intercepted strategic memos, deep market analyses, and they all claim this dump wasn't some organic panic.
No, not at all. They're saying it was a trap.
Exactly, a trap. So our mission today is to figure out the actual mechanics of what happened and, well, more importantly, what these sources claim it means for your own wealth.
Yeah, because the documents we're unpacking today, they treat this entirely as a psychological operation. Right. They basically frame this specific market fluctuation as a deliberate, orchestrated maneuver engineered to execute this massive global wealth transfer. But to really grasp the scale of the trap, you have to look at the global environment at that exact moment in June 2026.
Yeah, I was looking at the timeline and the sources, and the backdrop is just pure chaos. I mean, you have escalating geopolitical warfare in Eastern Europe.
Oh, absolutely.
And the Strait of Hormuz is essentially a powder keg, right? Just constantly threatening to sever global energy supply chains. And then over in the U.S., the national debt is expanding at this staggering, almost incomprehensible rate.
It was $1 trillion every 100 days.
$1 trillion every 100 days. It's insane. And core inflation is sticky, sitting right at 4.7% and just refusing to budge. So naturally, following basic economic logic, capital routes to hard assets.
Exactly.
Now, we saw the price of gold surge to a record $4,088 per ounce.
Which, I mean, in a textbook safe haven environment, so surging sovereign debt, persistent inflation, geopolitical instability, that structural surge of capital is exactly what you'd expect to see.
Right, because the system is visibly fractured.
Yeah, so institutional and retail capital alike, they're both seeking preservation. Everyone's looking for a life raft.
But then right at that critical peak, the SPDR Gold Trust, which is the largest institutional gold ETF on the market, executes this massive liquidation. 17 metric tons unloaded in a 4-day window.
It's just a massive amount of weight.
And the financial press immediately triggered widespread panic. I mean, the headlines were screaming that the safe haven trade was dead, gold had permanently peaked, inflation was somehow magically under control.
Right, miraculously.
Yeah, and that the price of gold was destined to crash all the way back down to $3,800. They were practically begging retail investors to get out.
They really were.
Okay, let's unpack this. Because dumping 17 tons of an ultimate safe haven asset during a global debt and inflation crisis is like, well, it's like an insurance company liquidating all its lifeboats while the ship is visibly taking on water.
That's a great way to put it.
It just mathematically makes no sense. It contradicts the core survival mechanism of the market.
Well, and the sheer irrationality of it is what flagged the attention of the forensic analysts who offered these memos in the first place.
Yep.
Because they argue that this liquidation makes no sense at all if you assume these funds are responding to, organic market forces.
Right.
Instead, the sources introduce the structural analogy to explain the mechanics at play. They call it the architecture of the shiny roof versus the paralyzed feet.
The shiny roof versus the paralyzed feet. Okay, that analogy completely reframes the media's reaction. If the media panic is just the shiny roof, it implies those frantic headlines are a deliberate distraction from whatever's actually happening down at the foundation.
Yeah, exactly. The text described the shiny roof as a manufactured behavioral filter. It's essentially a visual illusion engineered to project a false sense of systemic stability.
So they want you looking up.
Right. The authorities want you looking up at this freshly painted roof, which is the controlled, manipulated spot price on the ticker. But beneath that, you have the paralyzed feet.
The foundation.
Yeah, the undeniable physical reality of compounding systemic debt, structural currency devaluation, and just the exponential erosion of your purchasing power.
Wow.
The text actually used the term structural necrosis.
Structural necrosis.
Yeah, which is really just a clinical way of saying the global fiat monetary grid is rotting from the inside out.
So if dumping physical gold makes absolutely zero sense given this rotting economic foundation, we really need to look at what was actually dumped. Because if you're listening to this and picturing a fleet of armored trucks backing up to a high-security vault to offload 17 tons of heavy, shiny gold bars.
Yeah, our sources say you are completely falling for the illusion.
Right, so what actually happened?
Well, that's the core forensic truth exposed in these documents. SPDR didn't back up any trucks. They didn't sell physical atoms of gold. They sold what the sources refer to as paper gold. We're talking about exchange-traded fund certificates and synthetic futures contracts that just got dumped onto the COMEX, the primary commodities exchange.
So it wasn't metal at all, it was just a digital promise, like a spreadsheet entry being passed around.
Exactly. And the mechanics of how those spreadsheet entries were created, that is the secret to this entire operation.
How so?
The sources detail how these mega-scale Western ETX and Tier 1 banking institutions, who are very much aligned with central banking interests, they use synthetic derivatives to manipulate the digital spot price of actual physical matter.
Okay.
And they do this using leverage factors that exceed 100 to 1.
Okay, let's break that down for the listener, because 100 to 1 leverage sounds, honestly, almost illegal.
Yeah, it sounds crazy.
So for every 1 actual ounce of physical gold sitting in a vault somewhere, there are 100 digital claims trading back and forth on the screen.
It sounds extreme, but yes, that is the reality of the synthetic derivatives market. You know, historically, commodity futures were just a way for farmers to hedge the price of their crops before harvest.
Right, that makes sense.
But over decades, the financialization of these markets morphed into a system where the volume of paper contracts vastly exceeds the physical supply.
Wow.
So by dumping concentrated blocks of these synthetic futures contracts onto the electronic spot exchanges, these institutional entities can basically execute a predatory short ladder attack.
I want to focus on that phrase for a second, short ladder attack, because the text mentions it a few times. Basically, they flood the zone with paper, right?
Yeah.
From what I understand of the mechanics, these institutions trade these synthetic shares back and forth with each other at fractionally lower prices, and they do it in microsecond intervals.
Exactly, using high-frequency trading.
Right, and it tricks the trading algorithms into registering this massive organic sell-off, which then artificially suppresses the digital price feed of the gold.
What's fascinating here is you are artificially crashing the ticker without ever touching a piece of actual metal.
So if I'm hearing this right, it's basically like printing 1 million synthetic tickets for a concert venue that only holds 10,000 people, purely to artificially crash the resale value of the ticket.
That's a really good analogy, yeah.
You flood the secondary market with fake supply so the price collapses. But, and here's my pushback, how long can they actually keep that up? I mean, you can't just print infinite paper to cover finite physical stuff. Eventually, someone's going to want to actually attend the concert and sit in the seat, right?
Oh, absolutely. And the sources completely agree with your intuition there. You absolutely cannot permanently suppress finite physical atoms using infinite digital paper.
Okay.
It is a structural impossibility. In classical engineering, as the text notes, changing the digital blueprint of a building doesn't alter the physical composition of its foundation.
Right, the real world doesn't change just because the drawing did.
Exactly. The heavier the synthetic roof becomes, so the more 100 to 1 paper they print, the more violently it will fracture when the market actually demands raw physical delivery.
But creating a 100 to 1 synthetic fracture is basically financial suicide, unless you have some sort of ulterior motive.
Yeah.
And the sources argue this wasn't an accident, right? It was a targeted operation. The short-term goal of dumping that 17 tons wasn't to hold the line forever. It was to trigger a psychological liquidity trap.
Yeah, the memos use a very specific term for this trap. They call it the coup-luité.
The coup-luité.
Yes, which translates roughly to the century scam.
Man, that is some intense terminology.
It is.
But the mechanics they outline for how the trap actually springs totally back up the gravity of that term. By aggressively dumping those paper contracts and just painting the tape red, these institutions create this terrifying visual illusion on the global pricing screens.
Right, so the digital spot price plunges, which triggers algorithmic stop losses all across the board.
And then the retail crowd, the everyday investors out there, sees this plummet. And the authors of these memos use some pretty stark, almost cynical language to describe retail investors in this moment.
Yeah, it's pretty harsh.
They refer to the general public as a panicked herd or sleepwalking NPCs like non-player characters.
Right.
And they're analyzing retail psychology, claiming that the public just blindly follows the programming of the financial media. Now, obviously, we aren't taking a stance on whether the public are NPCs, but it really shows you how aggressively these analysts view the disparity between institutional and retail strategy.
Totally. The text suggests that the financial media acts as sort of the broadcast arm for this operation. The programming tells the public to look at the dropping price, panic, and sell their real assets to cut their losses.
It's just basic loss aversion psychology.
Exactly. The herd sees the price tumbling toward $3,800. They get terrified that the bottom is falling out, and they liquidate their physical positions. They sell their hard assets and retreat back into cash.
Back into debt-backed paper instruments. Here's where it gets really interesting, though, which plays right into the architect's hands. The sources claim that while retail investors are reacting to this panic, retreating into depreciating fiat dollars and digital risk assets, the elite banks are utilizing what are called dark pool liquidity networks to quietly execute the ultimate bait and switch.
Yeah, and the mechanics of a dark pool are fascinating because they operate entirely outside the public eye.
Right.
Dark pools are basically private financial exchanges created for massive institutional block trading. Think about it. If a Tier 1 bank tried to buy 10 tons of physical gold on a public exchange like the COMEX, the sheer volume of their bid would instantly drive the price sky high.
Oh yeah, public would see the massive buy order and pile in.
Exactly. So dark pools cross these massive orders off the lit exchanges, meaning the bid-ask spread and the trade volume remain completely invisible to the retail ticker.
So they don't spook the market. They can accumulate quietly while the public price stays artificially suppressed by their own short ladder attack.
And that is the bait and switch. While the retail investor is panic selling their gold at a manipulated discount on the public screens, the massive institutional players are operating in the shadows of the dark pools, quietly buying up the actual physical pool.
Wow.
It is a massive wealth consolidation protocol, perfectly disguised as a standard market correction.
So they're essentially shaking the tree with fake paper wind and then standing at the bottom with a massive invisible basket to catch all the actual physical wealth that falls out.
Yes.
And they get it at a huge discount because they manufacture the panic themselves.
Yeah.
But that kind of begs the question, why go through the trouble of this elaborate 17-ton illusion? Why do the central authorities and these mega banks care so much about suppressing the price of gold in June 2026?
Well, if we connect this to the bigger picture, it comes down to what gold represents historically. It is the ultimate barometer for the health of a fiat currency. According to the texts, this 17-ton maneuver is an act of psychological warfare executed at a very critical stage of the late-stage fiat cycle.
Okay, unpack that a bit.
Sure, so commercial banking relies entirely on faith. The central authorities must maintain the illusion of fiat value to sustain that faith.
Because if they don't, if the global crowd suddenly internalizes that paper money is rapidly dissolving, that the $1 trillion in debt every 100 days and the sticky 4.7% inflation are permanent features, not bugs, a systemic stampede into hard assets would instantly collapse the commercial banking matrix.
Exactly. It would trigger the mother of all bank runs.
The structural run on the entire system.
Right. So they have to keep public capital trapped inside their high-risk digital assets and debt instruments to maintain liquidity in the banking sector.
Okay, I see.
So they periodically manipulate the commodity pricing engine to generate these visual illusions of gold depreciation. And all the while, they are secretly transitioning their own reserves into unleveraged, unindexed physical infrastructure.
Sneaky.
Yeah, they are systematically escaping the burning building while instructing the public through the financial media to stay inside and keep painting the walls.
That is a brilliant way to frame it. So what does this all mean for you listening right now? If the macroeconomic game is rigged to this extent, if the entire digital pricing mechanism is just a 100-to-1 paper illusion designed to trap retail capital, how do you actually defend yourself?
Well, the sources don't just diagnose the necrosis, they actually outline a highly specific, actionable defense strategy.
Right.
They call it the sniper closing protocol.
The sniper protocol.
Yeah, and the defining characteristic of this protocol is a concept they call ghost mode.
Ghost mode. Okay, what is that?
Ghost mode dictates absolute, uncompromising immunity to digital market fluctuations and corporate media narratives.
Man.
The mechanical application of this means the moment you recognize that a drop in the digital spot price is not a loss of intrinsic value, but rather a tactical discount window engineered by the house, you just stop reacting to the ticker.
You essentially unplug from the financial matrix.
Exactly. Structurally, that means maintaining a leverage ratio of absolute 0 in the paper derivative markets. You do not buy their paper ETFs. You don't trade COMEX futures on margin.
Just opt out.
Right. You completely remove your capital from the paper theater. If you play their game on their platform, you are subject to their rules and their synthetic dilution.
And the texts are incredibly explicit about what you do instead.
All right.
Right? They argue for the physical standard. The strategy dictates converting your surplus, depreciating paper fiat, so your monthly cash flow, directly into physical 9999 pure gold bullion.
Yes.
And they even get down to the specific form factor, recommending small denomination round rings. Not giant cinematic bricks of gold, but small, untraceable units.
This raises an important point because the specificity of the form factor is crucial for the mechanics of a localized liquidation event. The strategy relies on securing physical density that is highly divisible.
Visible, right?
Yeah, large bricks are incredibly difficult to liquidate in a fractured economy without drawing institutional attention. Small denomination round rings offer pure divisibility for peer-to-peer transaction capability.
Now, I have to push back here on behalf of the listener because this starts to sound incredibly intense.
It does, yeah.
The source is explicitly talking about storing physical gold in private, offline safes, totally off the banking ledger, invisible to any sort of administrative tracking or taxation algorithm. In our hyper-digital 2026 world, where literally everything is an app and liquidity is instantaneous on our phones, isn't going completely off-grid with chunks of raw metal a bit extreme.
Well, the texts anticipate this exact friction point. It feels overly analog in a digital world.
Very analog.
But the authors argue that the analog nature is the entire point. Physical bullion requires no counterparty authorization. You don't need a banking server to be online. You don't need an administrative body to approve your transaction. And there's absolutely zero default risk. Most importantly, your physical holdings cannot be diluted by institutional paper certificates.
You hold it in your hand, and no amount of algorithmic short laddering can change the atomic weight of what you're holding.
Exactly. The extreme nature of the analog solution matches the extreme nature of the digital systemic necrosis they're diagnosing. The goal of the sniper protocol isn't day trading.
Right.
It's not about playing a volatility swing to make a quick 10% fiat return. It is about weathering the paper circus. You allow the paper markets to artificially suppress prices and panic all they want. Your wealth is preserved in immutable, dense, physical matter.
And the sources mention a very specific timeline for this weathering process. They talk about waiting for a projected 2027 to 2029 liquidation window. What are we actually waiting for mathematically?
We're waiting for the mathematical settlement. The texts project a point where the fiat matrix simply cannot sustain the debt compounding anymore.
Because of the $1 trillion every 100 days.
Exactly. When you are adding $1 trillion every 100 days to service existing debt, the yield curves eventually invert to a point of sovereign default. The paper markets freeze, leading to massive institutional defaults and forced systemic restructuring.
So while the people holding digital promises are completely wiped out by counterparty failures, your off-ledger physical wealth just clears instantly.
Exactly. And because you've preserved that absolute purchasing power outside the blast radius, you emerge into that crisis intact. You are then positioned to buy up real-world infrastructure distressed real estate, hard assets, operational businesses at deep court-mandated liquidation discounts.
That's wild.
Yeah, you are essentially adopting the exact same shadow accumulation strategy as the elite central banks, just executed on an individual sovereign level. You use the physical reality to survive the collapse of the shiny roof.
Man, okay, let's bring this all together. The deep dive today really reframes how we consume market news. That aggressive 17-ton dump by the SPDR Gold Trust in June 2026 wasn't a signal that the economy was healing or that inflation was tamed or that gold was losing its intrinsic value.
Not at all.
According to the mechanics outlined in these forensic texts, it was a massive, weaponized digital illusion. A predatory short ladder attack utilizing 100-to-1 leveraged paper to shake weak hands out of the market, which allowed institutions to scoop up the physical assets via dark pools.
Yeah, the overarching macro reality exposed here is that infinite paper is currently fighting a desperate mathematical losing battle against finite physical assets.
Right.
The institutions are executing complex tactical maneuvers simply to buy themselves the time they need to hoard the physical foundation, all while keeping the public trapped in the burning paper theater.
Which means, for you listening right now, it might be time to take a forensic look at your own portfolio and your own financial strategy. Are you holding the shiny roof of digital promises, paper ETFs, and synthetic exposure? Or are you standing firmly on the paralyzed feet of real, physical, unleveraged value?
Yeah, it's a huge question.
The entire macroeconomic game, as outlined by these memos, is meticulously designed to separate you from the latter.
It really demands a fundamental shift in how you measure your own wealth.
Yeah.
It moves the metric from tracking fluctuating digital numbers on a screen, which, as we've seen, can be spoofed in a microsecond, to calculating your actual physical possession free of any counterparty risk.
And as we wrap up this deep dive, I want to leave you with a final, lingering question to ponder on your own. It builds on everything we've unpacked today about this massive backdoor wealth transfer. If the architects of the global financial system are deliberately shaking retail investors out of hard assets, using fake price drops to secretly hoard physical gold completely off the ledger, what exactly happens to the entire digital economy on the inevitable day when the global elite finally demand physical delivery for all those 100-to-1 synthetic paper contracts?
Well, that day is the mathematical settlement.
And the math suggests it's not a matter of if, but when. Thanks for joining us on this deep dive. Keep your eyes open, and we'll see you next time.